talking about selling options, okay? People looking to potentially, generate income derived from options. That's one of the key objectives why people trade options. So we're going to get to that in just a bit. Again, the housekeeping here, options about risks for everybody. Those risks are outlined in the characteristics and risks of standardized options booklet. Get a copy of that through your broker or on our website, optionseducation.org. I just want to note that the examples that we're using, and more importantly, the things that we're saying, are not an enticement to get you to trade. What OIC is really all about is giving you the information from a perspective of education so that you're better armed when you do go out into the option space. And if you do decide to trade, you have a better understanding as to what those potential risks and rewards of trading might be. I've mentioned OIC and OCC. OIC is the educational arm of OCC, the Options Clearing Corporation. They are the clearing organization that clears the bulk of options trading in the U.S. Pretty much all of your stocks, ETFs, and the majority of your indices get cleared through OCC. And as you can see, we call ourselves the Foundation for Secure Markets. And then the educational arm, OIC, the Options Industry Council. For those not familiar with OIC, we are an unbiased organization. We are agnostic. We don't necessarily care if you trade options. We don't care how you trade options. What we do care about is, again, giving you those tools and resources you need in order to make a decision as to whether or not options are for you. And we do that mainly through our website, optionseducation.org, where we offer online courses, a monthly podcast that I produce, a monthly webinar program, 2 webinars a month. It's the second and third Wednesday of the month, 3:30 p.m. Central Time. And then our investor education team, options@theocc.com is our email address. Basically, myself and my partners, all of us 25 plus years in the business, we sit around all day creating options content and responding to investor emails asking us options-related questions. Now, a lot of those questions pertain to corporate actions. The company I'm investing in with options is merging with another company. What is that going to do to my position? I've got options on a stock that just underwent a reverse split. How does that impact my position? These are some of the questions that we address on a daily basis. But I should note that as we are not registered investment advisors, we do not provide advice, we do not make recommendations of any kind, and we do not talk about taxation. We are not tax advisors. But anything else is pretty much free game, all right? So shoot us an email, options@theocc.com, not only to get a copy of these slides that I used during this presentation, but also all of your options-related questions. A volume slide. Some of this may be familiar to many of you that joined us for our last session. A lot of people are trading options, right? 12 billion and change is a lot of option contracts. When I started in the business in 97, it's not even on the chart. It was so long ago. But, we were like under 1 million contracts a year. And now we're at, 12 billion and change. 50 million contracts a day are trading hands on average. I think the record, which fortunately I can't remember the exact number because it changes so often, but I think the single day record is somewhere in the 80 million contracts a day. It's just mind-boggling to know how many people are trading options now. That being said, there's a greater need than ever, at least in my opinion, for people to understand what it is they're getting themselves into. The demographic trading options is starting to skew a little bit younger. Some of you may have younger family members or children that are getting into options and interested in learning about them. But that's the key thing, the learning about them, right? They need a resource, a trusted, unbiased resource where they can go to give them the facts. We don't have any products to sell. We like to say that we're unbiased and agnostic because we're not trying to get you to trade options. We're not trying to get you to trade a certain way or a certain stock. All that we're trying to do is get you to understand what it is you're getting yourselves into, and hopefully armed with knowledge that could, maybe get you out of what you got yourself into if things aren't quite working out the way that we had hoped, right? But that's who we are. That's what we do. And we like to see, at events like this, people are coming up to our booth and saying, I'm on your site daily. I absolutely love it. Or I check you guys out every month for your webinar program. Those are the things that we like. We like to know that people are using our resources. We simply want people to know not only that we exist, but options exist as well, and how to trade those in a hopefully responsible manner. That out of the way, let's go ahead and get to the topic at hand. We're going to be talking about selling options. We're going to be talking about rights and obligations of sellers, or the rights of buyers, and the other side of the coin there, the obligations of option sellers. We're going to be talking about some of the pricing concepts that affect all options, whether it's buying or selling, and that's the Greeks. I'm sure a lot of you are probably familiar with the Greeks. They are theoretical pricing concepts that help us estimate how much the value of our option contract might move up or down depending on, certain external inputs, changes in days until expiration, changes in implied volatility, et cetera. So the Greeks help us estimate what our option value might, how much that option value might change. And then we're also going to talk about something that impacts option sellers directly, and only option sellers, and that's the concept of assignment. And I'll get into what that is in just a little bit. So let's go ahead and start out part one, rights and obligations. Call buyers and put buyers, option buyers and sellers. Option buyers have rights, sellers have obligations. A buyer of a call option has the right to purchase stock at their strike price from trade inception until that contract expires. A put buyer is going to be the opposite. They've got the right to sell that stock at their strike price from trade inception until expiration. If you are buying a call, you are expressing a bullish sentiment on the market. You think the market is going to go up, or you think the particular stock price is going to go up. Puts, typically you're going to be the opposite. You think that stock is going to go down. Benefits of buying calls or puts is that you can take advantage of market movement, whether it be up or down, depending on call or put, with a smaller cash outlay or lower fees than if you were to just trade that stock outright. So if I'm buying 100 shares of stock at $50 a share, I'm investing $5,000. I can control that same amount of stock by buying a call option at significantly less and significantly lower prices and capital requirements. Potential risks when I buy a call is I can lose everything. Really, it's no different than buying stock. If I buy stock at $50 a share, I can lose theoretically $50 a share. Hopefully that's not going to happen, and it certainly doesn't happen very often, and it certainly likely isn't going to happen overnight. Different from options. Options are moving quickly and significantly throughout the day. If I'm buying a put, I'm looking to take advantage of falling share prices and doing so cheaper than selling stock short. My account may not be approved for short stock selling, so buying a put might be a way to accomplish the same thing without those extra necessary approvals. But the flip side, and things that we're here to talk about today, is selling options. So if I'm a buyer and I've got the right to purchase stock, then you, sir, as the seller, are going to be obligated to sell that stock to me should I decide to exercise my rights as the option buyer, as that call option buyer. If I'm selling a put, I am obligated to buy those shares that are put to me if I get assigned. Market outlook, if I'm selling calls, I'm bearish. I think the market's going to go down. I think the stock is going to go down, typically, right? And that's if I'm simply selling the call by itself. If I'm simply selling the put by itself, I'm expressing a bullish sentiment. I think the market is going to go up. But these are ways that I can capitalize on those market sentiments that I have and get paid to do so. If I'm buying an option, I need something to happen with the stock, with the market, with implied volatility, what have you. I need that stock price to move some way, because if it doesn't, there's a concept called time decay that is going to erode the value of my contract each and every day. So I need something to happen positively to impact my position to offset that time decay. That's if I'm an option buyer. If I'm an option seller, I want just the opposite. I want nothing to happen, or I want things to happen the way that I want them to. If I'm selling a call, I either want the market to go down, or I don't want the market to go anywhere. It can stay exactly where it is, depending on my strike price. But the point being is, option buyers need something to happen. Option sellers don't want anything to happen, typically. Potential risks of selling options can be infinite. When I buy stock, there's no limit to how high that stock price can go. When I'm selling the right to buy that stock, which is a confusing way to say when I'm accepting the obligation to sell that stock, if I'm selling a call option, I may be obligating myself to sell stock at $50 a share. If on expiration it's trading $500 a share now because something, crazy happened, black swan event, or somebody tweeted something that was caused the market to do what it does. But the point being is, because there's no limit to how high that stock can go, there's no limit to my risk as a naked call seller. We say naked as to mean uncovered. There's a strategy called a covered call, where we're selling a call option against our stock. The reason it's covered is because our obligation to deliver those shares is already fulfilled. We've already got those shares in place. If we didn't have those shares in place and we had to go out into the market to buy them, if I sold a $50 call, I'm obligated to sell that stock at $50. If the market is now $500, I am obligated to buy stock at $500 a share in order to sell to you at $50 a share. I am not going to want to do that very often, right? I'm not going to be a successful investor if I do that too often. But the potential risks of selling as selling a call, potential risks are infinite or unlimited. Potential risks of selling a put is going to be that strike price all the way down to zero. If I'm obligated as a put seller to buy stock upon assignment at $50 a share, and that stock drops down to, zero, I'm still obligated to pay $50 a share for a stock that's worthless. So my maximum risk as a put seller is going to be my strike price all the way down to zero. Now, it would be somewhat offset by the premium that I collect when selling options, but it still is a very significant and substantial risk. Let's look at a couple graphs. If we're selling a naked or uncovered call, hypothetically, we sell a $50 call at a $2 premium. We are bearish on our forecast. We think that the stock price is going to drop, or we're thinking that implied volatility might decrease. For those of you that aren't familiar, implied volatility is the market's expectation. This is the way that I explain it, and let me know if you think it's as understandable as I'm hoping it is. It's the market's expectation of future volatility of the stock as expressed by the value of the option or the price of the option. Now, implied volatility, or just volatility as it itself, you can look back on a chart and see where the stock was yesterday, where it was 3 weeks ago, where it was 6 months ago. You can, look back and actually see how that stock performed. But we have no idea how it's going to perform going forward. And that's where implied volatility comes in. It's the market's expression of future volatility for that stock as expressed for the price of the option. So, and that was kind of an aside, so I apologize for that. But the thing about implied volatility is if it increases, option prices increase, which is good if you're a buyer, bad if you're a seller. So if I'm selling a call, I either want that stock price to decrease or I want implied volatility to decrease so my option gets cheaper. If I sell something at $2, I'm going to be profitable if I have the ability to buy it back for $1, right? So I want that $2 price to go down any way that I can, whether it's because the stock price, stock prices came down, or implied volatility decreased and that reduced the value from $2 down to $1. So either of those scenarios work for me as a seller. Break-even point. This is a concept that I think is incredibly important when we're investing, whether we're buying or selling. This is the point that tells me where I begin making or losing money. When I'm buying a call option, my break-even point is going to be my strike price plus the premium that I pay. And think about it. If I'm buying a $50 call and I pay $2 for it, it gives me the right to buy stock at $50 a share. But I paid $2 for that right. So I'm really paying $52 for that stock, right? That kind of makes sense, yeah? Conversely, as a seller, if I'm obligating myself to sell those shares at $50, but I'm getting paid $2 to do so, I'm really selling that stock at $52. So that's my break-even point as a seller. It's going to be my strike price plus the premium that I collect is going to be the break-even. So anything below $52, if the stock price finishes at expiration in this example, below $52, I'm going to make some money. If it's above 52, I'm going to lose money, right? If it's below $50, that's where I'm going to have my maximum profit. It doesn't matter if the stock goes down to zero, because what's going to happen, I sell you the call, I sell you the $50 call, you pay me $2. Stock on expiration is trading $25. You're not going to want to exercise your call and buy the stock from me at $50 a share when it's trading $25 in the market. So this gentleman's just going to let his long call option expire, which means that my short call option is going to expire unassigned, and that $2 premium I keep. I retain 100% of that. All right, so when we're selling options, ideally we want them to expire without value and unassigned. Break-even point 52, so anything below 50, that's where we're going to get our maximum profit. If we... I just lost a slide there. There we go. So our maximum gain, $200. Our maximum risk, unlimited. Anytime we sell options, the most we can collect, the most we can profit is that which we received in premium. When we buy options, our maximum risk is that which we put into it. When we're selling options, our maximum profit is that which we collect. All right, does that make sense? Let's look at puts. Selling naked puts, a bullish strategy. Some people look at it as a way to buy stock at a discount. That's kind of a strategy called a cash secured put, but really the concept is the same. We may be bullish on the stock and we're either looking to profit from increases in stock price. And we're not really profiting from the increase in the stock price, but what we're really doing is that price increase is reducing the value of our option. If the stock goes up from 50 to 60 and I'm selling that $50 put, I am obligating myself to buy stock at $50 a share upon assignment, right? But this gentleman here, bought that put from me, and he's got the right to sell me that stock at $50 a share, which he's certainly not going to want to do when it's trading 60 in the open market. So this gentleman's going to let his put expire without value, and he's not going to exercise it most likely, which means that on the flip side, my short put isn't going to be assigned. So it's not necessarily that I'm looking for an increase in the stock price to profit. What I'm looking for is that increase in the stock price to devalue my option enough to where really nobody wants it. Nobody wants to exercise or force me to buy the stock from them. And a decrease in implied volatility will do that as well. Anything that lowers those option prices, if I sell that put for $2, if decreasing implied volatility lowers that put price down to $1, then I'm going to go ahead and profit. So our maximum gain is going to be $200. Our maximum risk is going to be substantial. The reason, again, we say substantial, it's going to be our strike price all the way down to zero. If I sold that $50 put and stock goes down to $20, I am obligated to buy those shares at $50. Stock goes down to zero, I am obligated to buy those shares at $50. So that's why we say our risk when we sell naked puts is from our strike price all the way down to zero. And then again, that would be offset by whatever premium that we collect. Variations of selling calls and puts, and these are a little bit more popular strategies, more widely utilized. I don't believe that there are a lot of people that are out there trading, certainly not a lot of retail investors trading naked calls and puts. And again, we say naked because it's uncovered. A naked call, we don't have those shares to fulfill our obligation if we are forced to sell stock at our strike price. We have to go out in the market and buy that stock. So our obligation isn't collateralized, if you will. Puts, there's something called a cash secured put where if we're assigned on our put, we're forced to buy those shares. If we already have the cash in our account to do so, that's called a cash secured put because our obligation is already covered. We already have the financial means to cover that obligation. Now, one of the things about a naked option versus a covered option is going to be margin treatment. And margin typically varies from firm to firm, so I won't get into it too much, but your brokerage firm, your trading firm, when you're selling options, is going to require margin to cover what they consider anticipated risk. If I'm selling a call, right, naked call, that stock can go to the moon. My brokerage firm is going to say, well, we don't have to protect you if it goes to the moon, but, maybe at least to the, stratosphere. Maybe if it goes up to the cloud layer. So we're going to want some money just to cover a portion of that risk should things go wrong. If our risk is already collateralized, either through having long stock on hand, and that would be a strategy called a covered call, or if it's collateralized because we already have the cash in the account, that's the cash secure put, our margin treatment is going to be more favorable for us as investors. So just real quick, a covered call is where we're selling a call option either at the same time that we're purchasing that stock, or we already have that stock in our account and we're selling a call against it. A cash secured put, we're selling a put and we're depositing the funds required to fulfill our obligation. Should we get assigned, we're depositing those funds in our account. So that's the setup of these two trades. The objective of both are generally income generating. Anytime we're selling options, we're looking to generate income. With a cash secured put, it's maybe a little bit different because we're looking to potentially a phrase you may have heard of called buy the dip. Stock is trading 100. We like it there, but we would love it at 95. So maybe we sell a 95 strike put. We deposit the cash to buy stock at 95 in our account. And if the market does get down to that point, we're going to go ahead and buy those shares. But in the meantime, we've also collected premium when we sold that option. So we're buying a stock at a discount, number one, and we're getting paid to do it on top of it. Market outlook, both of these are generally neutral to moderately bullish. Potential benefits, potential risks. Most of those risks lie within that stock position, whether it's the market going to zero or stock getting called away, what have you. But these are some of the more popular variations of selling options. Selling the Greeks. The Greeks, as I had mentioned, are theoretical pricing inputs that help us understand how how that option value might change according to a number of external factors in the market. The Greek that most people are familiar with is delta. What delta is, it's the expected change in the value of that option for every $1 change in the stock price. The higher the delta, the more correlated those options are to the stock. So if we had, for example, an 80 delta and the stock moves up $1, our option is going to change by 80 cents or 80% of the change of the stock price. If we had a 20 delta option, there's a less correlation. So that's only going to move 20% for every $1 move in the stock. High delta options approach 1, low delta options approach 0. Speed is something that people use to describe delta, how quickly my option is going to change as that market changes. But some people also look at delta as the probability of my option finishing in the money. Now, in the money is a pricing concept called moneyness, and we've got in the money, at the money, and out of the money. In the money options have what we call intrinsic value, inherent value to that contract. If stock is trading $50 and I've got a $45 call, inherently that option is worth $5. That would be the intrinsic value. And because it has inherent value, we call it in the money, right? I can exercise that contract today, turn around and sell my stock, and I've got money in my pocket. So that option is in the money. At the money is where your stock price and your strike price are roughly equal. Out of the money is where, for a call option, your strike price is above where stock is trading. But the thing about in the money, at the money, out of the money is that it's going to determine the value of that contract that you are buying or selling. That's just a kind of an aside to moneyness and in, at, and out of the money. But when it comes to the deltas, call options have what we call positive or long deltas because they're positively correlated. When we're buying a call option, we want that stock price to go up. And when it does, we're theoretically profitable. So there's a positive correlation with call deltas and the stock price. As the stock price goes up, the call price is going to go up as well. Good if you're an option buyer, bad if you're an option seller. If the stock price goes down, the delta is going to lower the value of that option as well. Good if you are an option seller, bad if you're an option buyer. Puts, again, other side of the coin, puts are negatively correlated to that stock price, negative delta. So if I'm buying a put, even though the stock price goes up, that is going to negatively affect me because it's going to be lowering that price. If the stock is getting more expensive and I've got the right to sell stock at $75 and stock's trading $70, that option is going to be worth $5 or more. If stock price goes up and now it's $73 and I've got the right to sell at $75, well, the value of my position decreased because, now I've got the right to sell only $2 above where it's trading in the market versus $5. So as the stock price goes up, put prices go down. So put deltas are negatively correlated. We typically say a call option has a delta 0 to 100 or 0 to positive 1. Puts have a delta because they're negative, 0 down to -1 or 0 down to -100. So let's just go ahead and skip over to Theta, to time decay. Time decay is a friend of option sellers. Remember, time decay is telling us that with each passing day, that option is going to be worth less money, which is good as an option seller. If I'm selling it for $2, if tomorrow it's worth $1.99, not much of an impact, but at least we're going in the right direction. 2 weeks later, it might be worth $1. So with each passing day, the value of our contract is going to decrease. and that is going to benefit me as an option seller. One thing that I didn't mention earlier that I should is that time decay is each calendar day. So it does take into account weekends. It does take into account holidays. So each and every day, the value of our contract is decreasing. And when I was on the trading floor, what some of the traders that surrounded me would do is, say come Friday, and this was before a lot of everything was done via computer. Come Friday, the trader would ask his clerk, do me a favor, run my sheets, and sheets is what we call their overall position, shows all of the calls and puts and quantity of everything that they have in that particular security, what their aggregate position is. Run my sheets to show me what things will look like on Monday. Take 2 days out, we would say. And basically what they're saying is, let's take out all of that time decay over the weekend and give me a picture as what my position's going to look like come Monday morning, right? So just, again, just a little aside, it includes weekends. It's each calendar day. Option buyers, time decay works against. Option sellers, time decay works in their favor. And time decay isn't linear. So it's going to exponentially increase as we approach expiration. When we've got a lot of time, and let's look at another example here, when we've got a lot of time ahead of us, each passing day is only going to have a minimal impact in the decreasing value of our position. But as we approach expiration, that time decay is going to exponentially increase until expiration day, where there is no time value left. Remember, expiration day is going to be a binary event. Either the option is going to be worth its intrinsic or inherent value, or it's going to be worth nothing, right? There is no in between. All of that time value erodes and gets taken out of that option contract. So time decay, nonlinear, increases exponentially as we approach expiration. Assignment risk. This is, when I talk about selling options, this is kind of one of my favorite things to talk about. And the reason being is because for me personally, I think it's one of the most important concepts. Anytime you're selling an option, you have assignment risk, right? When you're buying an option, you have the right to purchase stock at your strike price, assume we're talking about a call, up until expiration, if you exercise that contract. If I'm selling an option, I have the obligation to sell that stock if I get assigned. So any short option, anytime we're selling a call or selling a put, we have that assignment risk. We have that obligation to fulfill our contract, regardless if we want to or not. So if we're getting assigned on a call, we are obligated and we have to fulfill that obligation to sell 100 shares of stock at our strike price. We will receive that assignment notice from our brokerage firm. We might receive it the day after expiration. We might receive it the Monday after a weekend. If expiration is on a Friday, let's say, we might get that assignment notice on Saturday. It may not come until Monday. It may not even come until later in the week. There is no rule or regulation or law determining a timeline for when you must receive that assignment notice, right? That being said, luckily in this day and age where everything is digital and computerized, I don't know that there's any situations anymore where people wouldn't receive their assignment notice in a timely manner. But just a little fun fact, as my colleague would say, only sellers get assigned, right? Here's the big risk for me, and here's the thing that it's not that I like talking about it, but I think it's very, very important to understand after hours trading and the risk that that has on short options. I'm a Chicago boy, which means that in addition to having excellent taste in food and pizza, our markets close at 3 p.m. Central Time. That's when our equity ETF markets close. All of the equities, most of the ETFs. Indices close typically 15 minutes later, so 3:15 Central Time. But as you know, the world doesn't stop spinning, right? The equity world doesn't stop spinning at 3 o'clock Central. There are, there's after hours trading, there's after hours news, and that's kind of where all this comes from. The after hours news. Let's say I am short, and I'll keep it simple. I'm short a $50 call. I'm obligated to sell that stock at $50 if I get assigned. Stock closes on expiration Friday at, what did I say, $50 call. Stock closes at $49.50. My option is out of the money by 50 cents. I'm not expecting anyone's going to come to me and, knock on my door and say, hey, Mark, I want to buy that stock from you for $50, even though it's trading 49.5 in the market. So my call option is finishing out of the money. I'm expecting it to expire worthless. I'm not expecting an assignment notice, right? And that's the end of the day. I expect to wake up Monday morning, look in my portfolio, my account statement, and see that premium that I collected when I sold that $50 call, 100% of it is in my account and ready for me to, do whatever I'd like with it. Buy a bunch of eggs, I guess. That's what I'm expecting. Now, the reality might be that at 3:15 or 3:20 or, whatever time it may be, the company that I was short those options with comes out with earnings, or they come out with some news release. I know just recently there was something about a company being added to the S&P 500, and that, naturally, impacted the share price of the security. The point being is that if news comes out and that $49.50 stock price at expiration now is trading $55, then the option buyer has the option, pardon the pun, to exercise that $50 call. Even though it finished out of the money at 49.5, they still have the right. As an option buyer, you've got the right to exercise your contract at any time, for any reason, up until expiration. Now, your trading firm will have certain policies in place telling you the hours of their exercise window. Their policy will state that you can exercise as a long option holder, as a buyer of a put or as a buyer of a seller. You can exercise your contract on expiration day up until whatever it may be, 15 minutes after the close, 30 minutes after your close, 45 minutes, whatever it may be. It's going to vary from firm to firm to firm. So different trading firms, different brokerage firms have different cutoff times. So, homework assignment number one for everybody is to contact your broker or look them up online, find out what that cutoff time is for exercise. That's rule number one, or homework number one. And the reason that you want to know that from a buyer's perspective is if there is that after hours news and my contract is technically out of the money, but I still want to exercise it, how long do I have to do that? All right. Is that clear with everyone? Now, how this applies to sellers is that just because my contract closed out of the money at 3 p.m. Central, closed out of the money by 50 cents, doesn't mean that I am not going to be assigned. If stock in after hours rallies up to 55, I likely will be assigned on that contract. And where I was, expecting to come Monday morning and see that profit in my account statement, not only do I not see that profit, but now I see that I'm short stock at $50 and the stock is trading 55 in the market. So on top of it, on top of a $5 stock loss that I certainly wasn't expecting, but now I'm short stock and assuming that I'm approved to have short stock. Now on top of that $5 loss, I've got interest rate charges by my broker. I've got fees for short stock that I'm charged by my broker. So I was expecting to see a couple $100 of profit in my account, and instead now I've got thousands in losses. The lesson for this is that short option writers, whether it's a call or a put, or even if you're in a spread, and you can even be a buyer of a spread, whether it's a call spread or a put spread, you're buying or you're selling. The point is that anytime you have a short option, you have an assignable position. And I know that it sounds, kind of redundant or maybe elementary, but the only way to avoid assignment is to not have an assignable position. All right? And the only way to not have an assignable position is to not have any short options. What all this means is that prior to expiration, maybe it's just a couple minutes before market close, and whether you're in a call or a put spread, a credit spread, short call, short put, you may choose, or it may be wise for you to choose, or you might even just want to think about choosing, closing out that short contract right before the market closes. If you can buy back that short call that is out of the money, that there's a very low probability of you getting assigned on that contract and you retaining 100% of that premium that you collected. But there's always that chance that something goes nuts. And under those circumstances, that's where you really get hurt. There was a gentleman that I was speaking to, and this sticks out in my mind. This was years ago. He was investing in this famous electric car company, and he had a short put spread. He had sold a put spread on it, and I don't quite remember the specifics, but both options finished out of the money. He was expecting to simply retain all of that premium that he collected, number one. But number two, because he was trading a spread, he had assumed that he had that he had limited risk and limited reward, right? Defined risk and defined reward. That's one of the reasons why people trade spreads. And typically that risk is going to be the difference between the strike prices minus the premium that you collect. So if you sell, for example, a $10 put spread, the difference in strike prices is $10. So you've got $1,000 in risk, $10 times that 100 multiplier. You've got $1,000 worth of risk minus whatever premium that you collect. So this individual had on, if I recall, I think he had like 70 put spreads that he was short, something like that. But the point is that he was expecting that, he had a defined amount of risk. And I don't remember if it was earnings that came out or, a tweet that somebody had made or whatever it may have been. But there was a huge movement in this electric car company stock over the weekend. And whereas this investor was expecting both legs of his spread to expire worthless, his short puts got unexpectedly assigned, and he now found himself long tens of thousands of shares. I want to say it was like 70,000 shares of this electric car company, and the stock was down, I don't know, like 15%. So whereas he was thinking he had $70,000 worth of maximum risk, and I think he woke up Monday morning and he was down like $1.25 million, some crazy amount. And the reason I'm bringing this up is he was asking, how can that happen? My spread expired out of the money. And that's exactly what this is. After hours trading can affect your position as an option seller. It's critical that you realize this. And for that reason, a lot of investors, whether it's retail investors, market makers, what have you, will buy back any short contracts that they have to close the position just prior to expiration. You remember a nickel, if an option's trading for a nickel, it's literally $5, right? Real world dollars, $5. So is it worth maybe spending $50 or $100 or, depending on how many contracts you have on, is it worth spending a little bit of money, eating into some of that premium that you're expecting to keep in your pocket for peace of mind? I like to use the phrase, think dollars, not cents. So don't worry about the nickel necessarily that it's costing you to close out this contract. Worry about the thousands that it may cost you by not closing out that contract. All right. Now, this isn't a recommendation. I'm not telling you that this is what you should do. I'm not giving you advice. What I am telling you is it's something from a perspective of education. It's something that happens, not all the time, but it's something that does happen from time to time. Be cognizant of it, understand the risk, and understand how to minimize that risk. All right. Is that clear? Pin risk is the last item that we're going to talk about, and it kind of goes hand in hand with those after hours. Pin risk is simply saying, look, I've got a position on, and I don't know the likelihood of my short, call, or put getting assigned. And maybe I'm short a $50 strike, and stock up until maybe the hour before expiration, maybe it's trading between 49.75 and 50.25. So it's kind of, going back and forth above and below my short strike. So I don't know if I'm going to get assigned or not. I'm uncertain as to what the probability is. So again, it kind of goes back to the concept of, there's another phrase that we have on the trading floor that was, when in doubt, close them out. If you don't know if you're going to be assigned and you're concerned about the possibility of assignment, simply close out that contract, right? You need to be aware of that potential for unexpected and possibly even unwanted assignment. And the way to avoid that is to simply close out that contract. So let's sum everything up with things to know. Sellers of options, you're obligated to fulfill the rights of the buyer should they choose to exercise. You're obligated to make good on the terms of those contracts. And the thing about it is, getting back to that after hours trading, is if you get assigned, you can't do anything with your long option. Let's say you had for simplicity's sake, let's say you bought a $50 call. Well, let's say you're an option seller. You sold the $55 call. That's the more expensive option. And you bought a $60 call, right? And stock finishes up, and I'm working up these numbers off the top of my head, so I hope that they're correct. Well, I'll tell you what, I know I'm going to mess it up, so let's get rid of the numbers. But here's what I'm getting at. Once you get assigned, you cannot then turn around and exercise that long contract. Assignment is the last part of the process. So if you get assigned, you can't say, well, I didn't realize I was going to get assigned. Had I known that, I would have exercised my contract. I would have exercised my long option. That's not how it works. Long option exercises are processed first, and then assignment notices go out last. So once you receive that assignment notice, there's no way for you to manage the position. You can't buy or sell stock to cover. You can't trade in or out of that option to manage the position. All you can do is fulfill that assignment. Anyways, that's just another reason why people typically might consider closing out that contract prior to expiration, just to take that risk off the table. Higher delta options, more sensitive to underlying price movement. So if you're a seller and you're selling a high delta option, sure, you're going to collect a lot of premium. High delta options are going to be in the money. The deeper we go in the money, the more they correspond and correlate with the stock price, the more expensive they are. If I'm selling in a deep in the money option, I need to know that if that stock price moves, the value of my contract is going to move very, very quickly too, and it's going to move significantly. So these are all potential risks that sellers keep in mind when choosing a strike price, choosing an expiration date, choosing a strategy. Time decay, as I mentioned, that's going to be the friend to option sellers. That's something that you want. And then assignment risk elevated during those after-hours sessions. It might behoove you to, again, homework, talk to your broker, find out when that exercise window closes. You might also find out what their exercise and assignment policy is. Do they automatically manage your position for you as expiration approaches? If you don't have the cash to cover an assignment, how is that going to work, right? If you don't have the cash to buy those shares, if you're selling a put, for example, Will your trading firm manage that position proactively on their own without your input? They certainly may. Again, these are questions that you're going to want to talk to your broker about. Find out what policies, procedures they have, and see how that might impact you. So that's going to do it for us. Again, some contact information, optionseducation.org is our website. We're all over social media, LinkedIn, X, YouTube, etc. So most of our videos that we have on our website are also on our YouTube channel. If you have questions or want a copy of the decks that we did, that we used today, please reach out to us, options@theocc.com.